All right, yeah, it's been a few months since I've posted something, and there were a bunch of stocks that I wanted to go over, but I've been very busy, and I'll have some more time soon. I'm leaving my job on December 31st, so I should have more time to look at stocks and make videos and things like that. And it's not bad news, it's good news. My employer has way too many employees. They usually uh, have a certain amount of attrition, and I guess that hasn't been happening lately. So they've offered people the opportunity to leave and get a buyout, and I think I'm going to take advantage of that. So, I had been sending out resumes and was willing to leave on my own, but, if they're going to pay me to leave, how can I pass that up? So, I should have more time after December 31st, but I had promised on the previous videos to do some more companies. I think I had said FRPH, Crocs, and a few others that I wanted to do a video on. And this one just sort of fell into my lap, and I figured I'd do a video on it. It's called PETS, or 1-800-PETS. And it's sort of one of those things where I wouldn't put a bunch of money into it, but if you have a lot of these small positions that you find that seem really interesting, you can sort of have a basket of them, and a lot of them will do well, and you'll do fine. I think it would be crazy to put 10 or 20% of your portfolio into one of these small ideas that seem really interesting but are risky. But if you have 10% of your portfolio, and then you have 10 or 20 of these names that you find which are really interesting and really cheap, that can work out really well. So uh, this company fell into my lap. Somebody that I know on a message board that's geared towards investors mentioned this to me, and we had some discussions on it. And it seemed really interesting. It's a company you might have heard of. They have the brand 1-800 Pet Meds. And during the pandemic, their stock was as high as $40. And because people were adopting a lot of pets and everything during the pandemic, hopes for this company were really high, and they kept hiring more people, and their costs went up, and the amount of money that they were pulling in per employee was dropping because they were hiring so many people, and wasn't really being managed well. And so it went from $40 a few years ago down to as low as $3. And they fired the CEO. They brought in a new CEO, this woman who's been turning things around, cutting costs, slashing costs, making things more efficient, and not only reducing headcount, but introducing efficiencies in the warehouse and everything like that. And it went from losing a lot of money to losing a little money, and now it's turned the corner and it's making money. So the last earnings call that they had, I had started to buy a little while I studied it, and it shot up 35% in one day. And I should have sold it there, but I didn't. And now it came back down to where it was before the earnings call. So I've been nibbling a little bit under $5 a share. I think it's like 460 now, where it seems like a really interesting idea. So again, this is not me telling you to buy or sell. It's a very small company, and I'm just going through my procedure. And with a small company like this, I have a different process than I would for a big company like Google. As I said, with these small companies, you sort of want a small position in a bunch of these little ones that you can find, and have a basket of these rather than going all in, 10 or 20%. That's not something that would make me feel comfortable. But why did I like this company? The market cap of the company is about $100 million. So, as I said, it's a very small company. And when you're looking at small companies like this, a lot of times they're not being followed by any analysts at all. And so when a company's not being followed by analysts, there's a better shot that you'll be able to get it at a good price, which is what happened when I bought Taylor Devices. It was trading at, I think it was like 10 or 12 times earnings. And it was a company that had no debt and a lot of cash, and it was growing. And it's unlikely that you would find a really great discount like that in a company that's, $4 or $5 billion, or 500 billion or $1 trillion, like some of the mega caps. But in these small cap companies, micro cap, nano cap, whatever you want to call them, it's a lot easier to find discounts because there aren't analysts looking at it, and retail investors tend to shy away from these names they haven't heard of. But anyway, this company that runs 1-800 Pet Meds, the whole company, you could buy the whole thing for $100 million. It has no debt. So what would you get for that $100 million? Well, you get about 50 million in cash. So you're getting $100 million the whole company sells for, and that company has 50 million in cash. So, if you bought a hot dog stand for $10,000 and it had $5,000 in cash, you didn't really pay 10,000 for it. You paid 5,000, right? So, $100 million company, you got 50 million in cash. So you're getting the whole company essentially for 50 million. And a lot of times when a company has a bunch of cash on the balance sheet and they're losing money, it's not such a great deal because eventually they don't turn the company around. They'll eat away at that cash hoard. But this company is actually making money, so that cash hoard isn't gonna keep going down. It's gonna get bigger and bigger. So how would you value that $50 million company that you're getting? Well, they have a warehouse slash headquarters in Florida that is worth somewhere, I calculate, between 60 and $120 million. So even on the low end, if you say it's worth 60, you're still getting a company where you're paying a price that's for the cash on hand and the real estate, and you get the business for free, which is making money. So the warehouse, I believe it's 180,000 square feet. I don't remember off the top of my head, and it's in Florida. And if you look it up on Google Maps, it's between the ocean and the golf course. So you could say it's worth more than the low end of 60, but just to be conservative, I think I'll value it at 60, and then just figure out, well, how much is the rest of the business worth? So again, for the market cap, you're getting, to me, it seems, just the cash and the real estate, and you're getting still a great deal. And then you get the pet medicine business for free. So pet medicine is a business where you had more of a moat than pet food, because if I wanted to start a pet food delivery business right now, I could do it from here. But pet medicine, because you're dealing with drugs, there's a lot more regulation involved, so it presents a barrier to entry. And even though they're pet medicines, a lot of times they're equivalent to the human medicines. And there's actually a company that got in trouble recently because uh, during the whole opioid crisis, uh, dogs and cats that are in pain get opioids as well. So it turns out a lot of people were going to veterinarians and pet pharmacies and saying my dog's in a lot of pain, and they were getting mailed things like Vicodin or OxyContin, and it was uh, making its way into the criminal trade. So it's a regulated business which keeps out competitors, and it's a small business, like I said, $100 million. So it's likely they'll get bought out now that they're making money. Why do I think that? There's a company that I use, or my vet uses, to send me my dog's pet medicine. It's called Covetrus. I've never heard of it, but I Googled it, and the company went private for $4 billion. So there's a large player there. And if you're a $100 million player competing against a $4 billion player, you're not going to be able to negotiate the same volume discounts on drugs as the larger player. So this company would be more valuable being acquired by somebody else. Uh, there's also Chewy, which, in addition to sending you pet food, sends you pet meds. And last time I checked, I think they're worth like $10 billion and have $1 billion in cash. So they could pay twice the market cap for this company, and it would just be pocket change for them. And it would still benefit Chewy to buy this company because Chewy trades at about 1.1 times revenue, and this company trades at 0.37 times revenue. So even if they pay twice the market cap of this company, it would still help Chewy's bottom line, because if your stock trades at 1.1 times revenue, this is call it 0.35. You pay twice as much, zero point 0.7. You're paying zero point 0.7 times revenue, and your stock trades at 1.1. That's going to help move your stock up. Um, so for someone like Chewy, that would help. There are other people that could acquire it. Tractor Supply just bought a company to get into this pet medicine business. Unfortunately, there were no numbers. They didn't say how much they paid for it. So, it's unclear. There's another company, Amazon, Walmart might be a good acquirer for this. Mars, which is a private company that makes candy, they are also in the pet business. So they make a lot of dog food brands. And recently they started a chain of pet hospitals called Banfield Pet Hospitals. So that would easily be a good acquirer for this, because, again, if you are a company like Covetris or Banfield, people don't really know your names, but they still remember 1-800 Pet Meds from when they would advertise on TV. So in addition to bringing in this revenue, which is profitable and helps your bottom line, you've also got a brand that you don't have to pay for because you're getting such a good price on this. So, I do think it's works better being acquired by somebody. And if they were to be acquired, what would you pay for it? So again, the market cap of the company, you're getting the cash and the real estate, still getting a good price. And they have, I think, 230 million in revenue. So if you think one times revenue is a good price for this, uh, you'll get a triple on this. So, it'll go from 5 to 15. If you think a half times revenue uh, is fine, that's another 100 million. So, it'll go from 5 to 10. And there's no guarantee that they'll sell this company, because they fired the CEO, and the new CEO, she seems to be doing a really good job. As I said, she cut costs and brought this company to profitability. But there are some headwinds because they are so small that, again, the pricing versus larger competitors, I think they're better off getting sold to somebody else. And one of the ways that they achieve profitability, besides laying off workers, leasing half of their warehouse to outside people, that, the parts that they don't need because they aren't as big now as they were before. So they lease the unused parts of the warehouse, and that's money coming in. They also slash the advertising budget, which is good for the short term, because now you've cut advertising and now you're profitable. But in the long term, that's not sustainable, because you sort of have to have this advertising mechanism to bring in new customers. And they did say that this quarter they're going to ramp up advertising now that they're profitable again, around the Thanksgiving season, to try to bring in new customers, and hopefully that plays out. No guarantee that it will, but at less than $5 a share, the whole company, 100 million, as I said, 50 million cash, somewhere between 60 and 120 million for the real estate, and somewhere between 100 and 200 million value of the business, depending on how you value it. Is it by income? Is it by free cash flow? But it seems like it's a pretty easy double or triple, and the question is when. That's unknown. If they get an offer tomorrow, you'll have a really nice return. If they get an offer 5 years from now, maybe not. But that's why for something like this, I like to take a small position. Uh, it's not even 0.5% for me right now, but I'm still buying a little bit here and there below $5, and while I study it. And the only thing that keeps me from making it a larger position is there's not really good comparables. So Covetris was sold for 4.1 billion, but where did they come up with that number? No one seems to know. Uh, Tractor Supply bought a pet pharmacy company, and they're not saying how much they bought it for or how much business it brought in. So, it's hard to get a comp there. Chewy trades at 1.1 times revenue. Uh, but Chewy's not profitable. And most of Chewy's business is dog food, dog toys. They do have a pet pharmacy business, which I'm sure makes more money than the dog food. But if the whole thing trades at 1.1 times revenue and the pharmacy is a small part, it's probably worth more than 1.1 times revenue, but how much more? Who knows? So, if you just price everything conservatively, you give the cash a value of 100 cents on the dollar. If the real estate is between 60 million and 120, and you value it on the low side 60, and then you value the business which is profitable at say 1.1 times revenue or one, you've got a double or triple in there pretty easy. It's just a question of when that gets realized, and if the people inside are smart enough to sell it, or sometimes when somebody turns a company around, they get attached to it and they say, hey, we're really smart, we're doing really good at this, let's just keep it going. But again, small position for me, and I have a basket of these small positions where some of them will play out, some of them won't. But it's really interesting just to, as you turn over a bunch of stones everywhere, you keep finding these interesting things. And if something's not a screaming deal, just move on to the next one. But this is one to think about and check out. So I'm not recommending to buy it, but just making a contemporaneous record of my thought process, so I don't subscribe to thesis shift and then just hang on and change my mind if the situation changes. But I'll hold on to this for a few quarters and see what happens. So I generally try to hold on to something for at least a year so that if I sell, I pay lower tax on it. But honestly, I should have sold this the day I bought, because the day I bought it, it went up 35%. And then if I sold it, um, that would have been a nice return for the year, and I would have had it in one day. And then when it came back, I could have bought it before, but um, live and learn. But it's at a price now where I don't feel bad buying more as I keep studying and looking for comparables to price it on. And I still haven't found any, but if I had a half or a 1% position on this as I keep adding, it would be fine. And then if I have 10 or 20 of these, which you don't know where they're going, it would be a nice thing to have in your portfolio, because some of them will do well. Not all of them, but if you have enough of these where the odds are in your favor, you'll do pretty well. So that's my thoughts on this. And it's a small company, so there's obviously risks involved because it's a liquid. It's pretty volatile around earnings time, and it's a small player in a large industry. So the best case scenario is somebody to buy them. And if they're smart enough to turn this company around, hopefully they're smart enough to figure that out. But that remains to be seen. So anyway, I'll try to do another video or two this week and put some stuff out there. They won't be as long as the previous ones, but just because time constraints of what I have going on at work. But hopefully you'll get something out of it. And if you have any questions, or if you have looked at this and think I'm completely wrong about it, just leave a comment, because I always like to uh, think about all sides of it. And if I have people agreeing with me, I don't really learn anything. But if somebody says, I think you're wrong about this because X or Y, then I have to think about it deeper, and that actually helps. So, anyway, let me know what you guys think, and stay tuned for the next video.